Unlike a secured loan, an unsecured loan doesn't require any assets as security. This means that unsecured loans carry more risk for lenders, leading to some notable differences between the two. So how does a secured loan actually work? Let's break it down. Usually, a secured loan provides you with a lump sum amount, often subject to fixed interest rates. Although some secured loans may have a drawdown facility and a variable interest rate, you will then repay the loan through monthly payments over a fixed duration. As long as you make all the repayments within the agreed repayment period, you'll pay off the full loan amount along with the interest. To help you understand secured loans better, let's imagine a scenario. Let's say you want to make some home improvements and you need £15,000 for the project. Fortunately, if you have over £100,000 in home equity, in that case you'd be able to take out a secured loan of £15,000 against your property equity, providing you with a lump sum to cover the cost of your improvements. However, it's essential to remember that not all secured loans are the same. Some may be cheaper than others, so be sure to compare your options and find the best deal that suits your needs. Now, what happens if you find yourself unable to repay a secured loan? Well, if you default on your repayments, the lender can take further action to recover the money owed, along with any fees. Since the loan is secured by an asset, such as your property, the lender may choose to foreclose on the property and force you to sell it. The proceeds from the sale would then be used to recover the outstanding debt. Secured loans are usually the junior lien of credit on a property, while mortgages used to buy the property are the senior lien of credit. This means that the mortgage has first access to the sale proceeds. So if there's not enough money left after paying the mortgage, the secured loan debt may not be fully cleared. This situation could arise if you have negative equity, and it may prevent the secured loan company from forcing the sale of a property. If you find yourself struggling to keep up with secured loan repayments, don't panic. There are steps you can take to navigate through the situation. It's worth speaking to a debt charity who can provide guidance and support. Additionally, you could also check out our blog post on how to get out of a secured loan for more information and practical tips, which I'll link in the description below. Now let's talk about the different types of secured loans that are available. Secured loan encompasses a variety of options, each with its own specific purpose. Some common types include generic personal secured loans, home equity loans, HELOCs, home improvement loans, homeowner loans, and second charge mortgages. Home equity loans, for instance, allow homeowners to borrow against their home equity. These loans typically provide a lump sum with a fixed interest rate. If you're specifically looking to fund home improvement projects, you may consider home improvement loans. They function similarly to home equity loans but are specifically intended for making improvements to your property. Homeowner loans are another type of secured loan that uses your property as collateral. While they share similarities with home equity loans, there may be some differences worth exploring. On the other hand, second charge mortgages refer to debts secured by a property that already has an existing senior lien of credit. Now, you may have come across the term HELOC during your research. HELOC stands for Home Equity Line of Credit and is classified as a second mortgage. It allows homeowners to borrow against their equity, which is the value of their home minus the amount owed on their primary mortgage. Interestingly, if you already own your home outright, the HELOC becomes the first mortgage rather than the second. When it comes to determining how much you can borrow with a secured loan, several factors come into play. The lender's product, the value of the asset used as collateral, your income, your existing debt, as well as a credit check all play a role in determining your borrowing power. You can use a secured loan calculator to get an idea of how much you might be able to borrow, but keep in mind that the results may not reflect what's actually offered in a real application. Now let's explore the pros and the cons of secured loans. It's important to weigh up the benefits and drawbacks before you make a decision. On the pros side, secured loans offer several advantages. Firstly, you can typically borrow a larger amount compared to an unsecured loan. This can be beneficial if you have significant financial needs. Secondly, secured loan rates are often lower than those of unsecured loans, which can result in lower monthly repayments. And lastly, there's a variety of secured loan lenders to choose from, providing you with options and flexibility. However, the cons. One significant disadvantage is that you put your asset, such as your home, at risk. If you're unable to repay the loan, you could potentially face foreclosure, leading to the loss of your property. Additionally, you may have to pay fees when setting up and ending the loan. So it's important to factor those costs into your decision-making process. You may be wondering if there are any age restrictions for secured loans. Generally, secured loans are available to individuals who are at least 18 years old. However, it can be more challenging to obtain a secured loan in your older age, due to having less years of work left to pay back the loan before you retire. If you've already retired, then you may be able to still get a secured loan. If you're able to prove to your lender that your earnings from your pension, investments, and other sources of income are enough for you to pay back the loan as well as pay for your essential living costs, then it is likely that the lender might just approve your loan application. If you have additional sources of income such as rental income or dividends, then it's very important that you mention them in your application. Additional sources of income will definitely work very much in your favor and will increase your chances of getting approved. Now let's address a common question. Will a secured loan improve your credit score? The answer is yes, it can. By taking out a secured loan and consistently making the repayments on time, you can demonstrate your ability to manage your finances responsibly. This positive payment history can lead to an improvement in your credit score over time. However, it's important to note that a secured loan, especially one secured with your property, can impact your ability to remortgage in certain cases. If you are interested in obtaining a secured loan, you have various options available to you. Banks, mortgage companies, and online secured loan lenders are all potential sources for securing the loan that you need. The secured loan approval process typically involves several steps. It starts with researching different secured loan options and assessing your choices. Once you've decided on a specific loan, you'll need to complete an application and provide any necessary supporting documents. In some cases, a property appraisal may be required. Finally, the lender will review your application and make a decision based on your eligibility and your financial circumstances. Now, you may be wondering how long it takes to get a secured loan. Generally, the process can take anywhere from 2 to about 6 weeks. However, certain factors can expedite the process, such as when a lender doesn't require an in-person property appraisal or can conduct the appraisal quickly and without complications. Once your secured loan application is approved, the funds are typically deposited in your account promptly, sometimes even on the same day. It's important to mention that some lenders claim to offer secured loans with instant decisions. However, it's essential to understand that these decisions are typically based on a prior assessment of your likelihood of approval rather than an actual application. Be cautious of such offers and always seek clarity before you proceed. Lastly, let's address some common obstacles that may prevent you from obtaining a secured loan. Adverse credit history, including previous issues such as individual voluntary arrangements, IVAs, or county court judgments, CCJs, can make it challenging to get approved. Self-employed individuals may face hurdles if they've recently established their business and lack sufficient evidence of income through their accounts. Despite these challenges, there are options available for individuals with bad credit. Some lenders specialize in providing secured loans for people with less than perfect credit histories. However, it's important to note that the interest rates on these loans may be higher. You can use the lender's bad credit secured loan calculators to get an idea of the potential cost. Remember, to avoid any lender offering a secured loan with no credit check, as they are likely operating illegally. When it comes to choosing the best company to take out a secured loan with, you have two options. You could go directly to the lender or work with a secured loan broker. Regardless of the path you choose, it's critical to conduct a thorough comparison of secured loans. Consider factors such as interest rates, repayment terms, fees, and customer reviews to find the most suitable and competitive loan for your needs. If you're interested in finding a loan for your circumstances, then simply click the link in the description below and fill out the short form. It contains a few questions like whether you're a homeowner and how much you'd like to borrow, and it'll give you access to quotes from around the UK tailored to your circumstances. It's totally free to do, and of course, it won't affect your credit score. Click the link in the description below and fill out the short form to try it out today.